Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, let's start with the 10-year US Treasury yield, as it's been the one thing that's really been leading equity markets a merry dance in recent months. Now, despite more toing and froing from the 10-year US Treasury yield, it's currently sitting just above its 200-day moving average at 1.26%. So given this stability, perhaps it's unsurprising then that we see most developed markets move higher between around about 0.5% to 1% since the last time I did this show. Now, that doesn't mean that equity markets have been completely calm this week and without incident at all. If you look at Asian equities and emerging market equities as a group, then they are down 5.5% and 4.5% respectively since last time, which is a massive move. Now, the reason behind this move is that Chinese authorities have clamped down on a range of sectors in China, particularly some of the big tech stocks out there. So some of the big tech companies have been hit quite hard in the last week. If you look at Tencent, in particular, its share price is down around 20% in the last 3 days, and Alibaba's is down around about 10% in the last 3 days. So they are huge moves, and given that Chinese equities and these stocks in particular make up quite a portion of some of these wider indices of Asian equities and emerging markets, that's why we've seen those falls on those wider indices. Now, often when you see big Chinese tech get hit, it can be contagious across to US technology companies. And there was a lot of fear over that. And analysts have been racing to give their opinions on this. And a lot of them think that the majority of these moves for Chinese tech companies lower won't necessarily be as contagious and brought across to US equities. But having said that, we did yesterday see US technology stocks take a bit of a hit. So the NASDAQ fell as much as 2% during the day yesterday, which, okay, is not what the size of the moves we've seen over in China, but it was a significant move because it was centered around technology stocks and not other areas of the market in particular. And part of the reason is obviously fear of the high valuations we're seeing in growth stocks at the moment, but also this technology clampdown in China and obviously bleeding across to general risk appetite in the technology area. So is that it for technology stocks? Is that wobble all over? I mean, we're waiting for equity markets to open today to see what will happen in the US after yesterday's sell-off. And don't forget, in the last 24 to 48 hours, we've had some technology earnings from the likes of Microsoft, Apple, and Alphabet, which is Google. And these have been some strong earnings numbers yet again. And if you look at the sort of pre-market moves, there's a bit of a mixed bag. Despite the strong numbers, some of those are going to be taking a bit of a hit if the pre-market figures are to be believed, while others are going to rally. So it's a bit of a mixed bag. The suggestion is technology stocks are going to open slightly down, but we'll have to wait and see. And it's quite important because obviously technology stocks have been leading the market higher as we've seen that narrowing of breadth in US equities and equities globally. But going back to Asian equities, they remain an interesting universe at the moment, and particularly Japanese equities, because there's been a slump. It's almost been a slow motion decline, a pullback, and in fact it's been a correction of 10% since the highs back in February, and that's alongside a slump in the yield of the 10-year Japanese government bond. Now that's starting to point towards a regime shift in Japan, one towards slower economic growth following the rebound after COVID, and one where we're going to probably see a period of deflation. So this goes to show if we start to see an economic shift, then we are likely to see a similar pattern. If we see an economic shift, I should say, in the US or in Europe, then Japan is giving us a hint as to what we might see in terms of equity moves. So we've had that shift in Japan. We've had a bit of a pullback, a 10% correction. We're still pushing or falling downwards. So we've not had that rebound as yet. How far could it fall? We'll have to wait and see. But it is a bit of a bellwether at the moment, a bit of it gives us some insight to what could happen if there is a sudden shift in perception of the future economic growth in the US, the UK, and Europe in particular, and also on the path of inflation. Now, Interestingly, the IMF came out today and has actually upgraded the forecast for UK growth this year up to 7%, which makes it one of the fastest, or would make it one of the fastest growing economies in the G7 this year, which is obviously a real positive. If you look at the FTSE 250 today, that's one of the reasons that is up, because obviously the FTSE 250 has a greater exposure to the domestic economy in the UK. So that is positive news. So we may not be at that stage where we're seeing an economic shift towards slowing growth. At the moment, we're still in that economic rebound. How long can that last? I mean, if we shift away from equity markets at the moment, then one interesting asset, which again is a bit of a marker for risk appetite, is Bitcoin. We've seen Bitcoin run ragged this week, collapsing down towards 30,000, then rebounding up towards 38,000 again on fears of clampdowns globally. But then after news from Elon Musk, the idea that he may start taking payments via Bitcoin again for Tesla, then Amazon put out a job description which suggested, or people interpreted to be a sign that they may look to be able to take Bitcoin or cryptocurrencies as a means of payment. That started to push the price of Bitcoin higher, and we've seen since then a small pullback. That fluctuation is pretty much a reflection of risk appetite at the moment, where everybody seems to have one foot out of the door. But really the big story in the next 24 hours is going to be the Fed. So the US Federal Reserve is going to announce its latest policy decision. So everybody's expecting nothing much to change. But if it does, then we could see a market wobble. But the other big thing is going to be the rhetoric around inflation. And some people are suggesting that this could be the time where bond yields finally start to break higher. Because at the moment, you could argue that bond yields in the US are falling. So if you look at the 10-year US Treasury, which is counter to what they might expect if economic growth is going to continue to boom and we're going to see inflation. So it'll be interesting to see what happens following this US Federal Reserve announcement. So I suggest, if you're looking at your phone app later on, have a quick look at your stock app, have a look to see what the NASDAQ, the S&P 500 and the Dow Jones are all doing, and what the 10-year US Treasury yield is doing. If we see some wild moves there, then you know that the Federal Reserve and Jerome Powell has said something following the announcement of the latest monetary policy decision, and then you can go and have a look at the news. And of course, I will talk about it next week on Damien's Midweek Market. So that is it for this week. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. Twitter, money to the masses with a number 2. We're on Instagram, Facebook, TikTok, and of course, do not forget to subscribe to our YouTube channel.